Hello, I'm John A.G., and there's a specific kind of unease that only appears when something you trust behaves correctly on the surface, but incorrectly underneath. When all the signals you were taught to rely on still exist, yet no longer mean what you think they mean. It's not panic, it's not fear. It's that subtle moment when your confidence pauses just long enough for doubt to slip in, and once it does, it doesn't leave quietly. That moment arrived in the silver market while most people were asleep, and the reason it matters has very little to do with price. People are trained to believe that markets speak clearly, that price is the ultimate truth teller, that when something drops violently it must be because reality changed just as violently. That belief feels safe because it implies order. It implies fairness. It implies that if you're paying attention, you won't be blindsided. But every once in a while, a market move doesn't clarify reality. It contradicts it. And when that happens, the contradiction itself becomes the signal. On February 5th, 2026, silver didn't drift lower, it didn't roll over, it didn't correct. It was forced down with speed and scale that immediately separated the informed observer from the casual one. A 22% collapse in roughly 2 hours on the Shanghai Futures Exchange, from around $90 to the low 70s, executed while Western markets were largely inactive. That timing was not incidental, it was tactical. Moves designed to overwhelm perception are rarely accidental. What followed was predictable on the surface. Charts broke. Commentators rushed to explain volatility. Social feeds filled with certainty, both bullish and bearish. But beneath that noise, the structure of the silver market revealed something far more important than direction. It revealed how much of the system exists only as an agreement not to test it. In that single morning session, more than 1.3 billion ounces of silver were sold on paper. That number should stop you cold if you understand scale. The entire world produces roughly 800 to 850 million ounces of silver in a year. Every mine, every continent, 12 months of extraction, all combined, still fall short of what was sold in hours. That's not a statistic you gloss over. It's a statement about the nature of the market itself. One futures contract on the Shanghai Exchange represents approximately 500 ounces of silver. On the April 2026 contract alone, around 1.44 million contracts traded. That's more than 700 million ounces tied to a single delivery month in a single session. When you aggregate volume across contracts, you're staring at nearly double annual global mine supply transacted before lunch. That is not hedging activity responding to new information. That is pressure applied deliberately to price. Here's where the false comfort sets in for most people. They hear that futures markets are large, that leverage magnifies moves, that volatility clusters. All of that is true. But those explanations only work if the underlying asset is abundant. They fail when the physical market is already tight. And in the days leading up to this event, the physical silver market was doing the opposite of signaling surplus. Just before the crash, physical metal was leaving vaults at a pace that hadn't been seen in years. Roughly 3 million ounces were withdrawn from COMEX inventories in a single day. Nearly 2 million ounces exited Asahi. Close to 1 million left HSBC. Hundreds of thousands were pulled from JP Morgan. Total reported inventory fell toward 400 million ounces, with registered silver, the metal actually available for delivery, estimated by some to be barely above 100 million ounces. Metal doesn't leave vaults like that without intention. At the same time, futures participants began behaving in a way the system quietly depends on them not behaving. In the first 4 days of February alone, more than 3,500 silver futures contracts stood for physical delivery. That represents about 17.5 million ounces of metal, where holders explicitly rejected cash settlement and demanded silver. Normally, only a tiny fraction of contracts ever result in delivery. 1 to 3% is typical. Approaching full settlement is not normal. It's a vote of no confidence in paper promises. Now place these facts side by side. Vaults draining, delivery requests surging, and simultaneously over 1 billion ounces sold on paper in hours. The contradiction is so extreme it almost feels surreal. You cannot build solar infrastructure, electronics, or data centers with synthetic ounces. Industrial systems consume physical inputs, not accounting entries, yet the paper market was suddenly implying an abundance so vast it crushed price. That disconnect is not noise, it's the message. What happened after the crash made the message even clearer. Western spot prices collapsed into the mid-70s. Futures settled slightly above that. But in Shanghai, spot prices held in the mid-80s, and futures hovered near 90. A $10 to $15 premium persisted in the largest silver-consuming region on Earth. Dealers didn't cut prices. They ran out of metal. Kilogram bars carried double-digit premiums. Mints reported sold-out inventory. Refiners were booked weeks in advance. If the price collapse reflected genuine oversupply, physical prices would have followed. They didn't. Instead, the paper market unraveled while the physical market quietly tightened. This is the first mechanism you need to understand. because it explains almost everything that follows. Paper silver and physical silver are not the same market. They are two systems pretending to be one. One can expand infinitely. The other is constrained by geology, energy, labor, and time. As the forced selling unfolded, another signal appeared that almost no retail participant understands until it's too late. London briefly moved into backwardation. Buyers were willing to pay more for immediate delivery than for future delivery. In commodity markets, that is a stress flare. It indicates urgency. It indicates preference for possession over promise. It indicates that confidence in future settlement is weakening. Backwardation doesn't appear because of speculation. It appears because of fear of delay. At the same time, exchange for physical spreads began flashing tightness. Regional divergence expanded. London became the strongest bid. China maintained premiums. Western futures deleveraged aggressively. This wasn't a synchronized global sell-off. It was a fragmentation event. Paper was being sold. Metal was being absorbed. The system was bifurcating in real time. This is where the deeper risk begins to form, though it doesn't announce itself yet. When leverage is forcibly removed from futures markets while physical demand remains firm, price stops functioning as a reliable signal. It becomes distorted by mechanics rather than fundamentals. Margin calls don't reduce demand. They eliminate participants. And when those participants were supplying synthetic liquidity, their removal alters the structure of the market in ways that don't resolve quickly. It's easy to look at a 22% drop and conclude something broke in silver itself, but nothing fundamental changed in 2 hours. Industrial demand didn't evaporate, mine supply didn't surge, currency debasement didn't reverse. What changed was positioning. Leverage was flushed. Weak hands were forced out. Capital transferred from those renting exposure to those quietly accumulating metal. That's how markets cleanse themselves without fixing their underlying imbalances. History doesn't repeat outcomes, but it does repeat mechanics. Every time a market suppresses price through synthetic supply while physical demand grows, the eventual adjustment becomes more violent. Paper can delay repricing. It cannot eliminate it. All it can do is compress pressure until the release becomes unavoidable. And that leaves us at the end of this first act with an unresolved tension that matters far more than any price target. If the largest paper sell-off in modern silver history didn't loosen physical supply, didn't collapse premiums, and didn't restore confidence, then the move wasn't a resolution. It was a test. And the system just showed you which parts of it are real and which parts only work until too many people ask for the same thing at the same time. After the violence fades, after the charts stop collapsing and the commentators move on to the next distraction, the market enters its most misleading phase. Nothing looks urgent anymore. Prices stabilize, volume thins, confidence slowly seeps back in. This is the moment when most people assume the danger has passed, because they've been conditioned to associate risk with motion. But structural risk doesn't announce itself with noise. It settles in quietly, like a pressure change you don't feel until something gives way. The first adjustment always happens behind the scenes. Exchanges respond not to headlines, but to exposure. When margin requirements are raised after an event like the Shanghai collapse, it isn't because regulators suddenly care about trader safety. It's because the system itself felt strain. Margin hikes are defensive tools. They force leverage out. They reduce open interest. They protect clearinghouses from cascading failure. In other words, they signal concern, not confidence. Higher margins change who is allowed to participate. Positions that were once manageable become impossible to maintain. Traders who relied on cheap leverage are forced to exit, not because their thesis failed, but because access to capital was withdrawn. This process doesn't discriminate between good ideas and bad ones. It simply removes anyone who cannot meet the new requirements. And when that happens in a market already tight on the physical side, price can drift lower even as underlying stress increases. This is where most observers get confused. They assume falling prices confirm bearish fundamentals. In reality, forced deleveraging often suppresses price below where fundamentals would otherwise hold it. The selling is mechanical, not discretionary. It's liquidation, not conviction. Once that liquidation runs its course, the market doesn't reset to neutral. It resets with fewer participants, less liquidity, and a different balance of power between paper claims and physical supply. To understand why that matters, consider the position of a large short seller after an event like this. On paper, the crash appears to validate the trade. Price fell sharply. Longs were flushed out, but the win is conditional. A short position only becomes profit when it's closed. And closing requires liquidity. It requires someone willing to sell metal or take the other side. When physical inventories are falling and delivery requests are rising, that liquidity becomes fragile. This is where second-order effects begin to dominate. Industrial consumers don't respond to volatility the way speculators do. They don't step away when markets become unstable. They step closer. Their risk isn't price fluctuation, it's interruption. If silver isn't available when needed, production stops. Deadlines are missed. Contracts are broken. For them, Paying a premium is preferable to facing uncertainty. So when paper markets wobble, physical demand often firms rather than weakens. That behavior explains why regional premiums held after the crash. Shanghai didn't collapse because consumption didn't collapse. The real economy doesn't trade on margin, it trades on delivery. When futures prices fall but supply chains don't improve, the message industrial buyers receive isn't relief, it's warning. They interpret the move as dysfunction in pricing, not evidence of abundance. History doesn't offer neat predictions, but it does offer consistent lessons about mechanisms. Commodity markets have repeatedly attempted to cap price through paper expansion while physical demand grew beneath the surface. The strategy works until it doesn't. For a time, synthetic supply absorbs pressure. Eventually, physical constraints assert themselves. When that happens, the adjustment isn't smooth. It's abrupt, because the system has been storing imbalance instead of resolving it. The most dangerous misconception is that systems fail at the moment of maximum stress. They usually don't. They fail later when participants believe the stress has been managed. After margin hikes, after volatility subsides, after confidence returns just enough to encourage releveraging, that's when fragility peaks. The structure looks calmer, but it's thinner. Fewer participants, less depth, more sensitivity to shocks. This is also the phase where policy considerations quietly enter the conversation. Explicit intervention always sounds extreme until it becomes necessary. Price floors, trading halts, position limits, these tools exist for a reason. They're designed to prevent market behavior from spilling into broader economic disruption. When physical supply is critical to infrastructure and industry, authorities have an incentive to prevent prices from falling to levels that discourage production or hoarding. For anyone positioned short, that introduces asymmetry. Downside gains are finite. Policy risk is not. If a floor appears, not through announcement but through action, a short position can be trapped instantly. Losses become fixed. Margin requirements spike. Liquidity disappears. And if delivery is demanded in a tight physical market, the obligation shifts from financial to material. Metal must be sourced at whatever price is available. That isn't a theoretical risk, it's a structural one. This tension is why markets prefer ambiguity. Uncertainty discourages aggressive positioning. It keeps leverage cautious, but ambiguity also erodes trust. When participants can't predict how or when rules might change, they compensate by reducing exposure to promises and increasing control over assets. Over time, that behavior shows up as a preference for physical ownership, direct custody, and minimized counterparty dependence. You can already observe this shift in subtle ways. Large entities reassessing where and how metal is stored, states exploring direct ownership rather than bank custody, institutions questioning whether traditional intermediaries align with their risk tolerance. These moves don't generate headlines because they're administrative, not dramatic, but they reflect a deeper recalibration of trust. From a practical standpoint, this is where mental frameworks matter more than forecasts. One useful distinction is between volatility and pressure. Volatility describes how violently price moves. Pressure describes the direction of imbalance. They don't always align. Another distinction is between exposure and possession. Exposure can be unwound instantly. Possession cannot. That difference becomes critical when settlement risk rises. There's also a timing framework worth holding. Markets move through phases of accumulation, leverage, distribution, and reset. The Shanghai event marked a reset in leverage, not a reversal in accumulation. Physical accumulation has been ongoing, largely unnoticed by those focused on screens. That process doesn't reverse because traders exit. If anything, price weakness invites longer-term buyers who were previously priced out. The most uncomfortable realization is that stability isn't the natural state of complex systems. It's something that has to be maintained, often at increasing cost. When maintenance relies on distortions rather than balance, those distortions eventually dominate outcomes. At that point, price stops reflecting truth and starts reflecting negotiation, policy, and scarcity, which brings the story to its unresolved midpoint. Deleveraging is still working through the system. Physical demand hasn't retreated. Confidence in paper mechanisms has been dented, not destroyed, but dented enough to change behavior. Policy tools are tightening conditions without restoring normalcy. The surface looks calmer, but the structure underneath is thinner, more brittle and less forgiving. The real question moving forward isn't whether silver finds a short-term bottom or retests recent lows. It's whether a market built on infinite claims can continue operating unchanged when more participants quietly decide they prefer metal over promises, delivery over settlement, and certainty over convenience. When a system reaches this stage, the danger no longer comes from what is visible, but from what has quietly stopped working the way it used to. Price still updates, trades still clear, charts still print. From the outside, everything appears functional. But internally, the incentives have shifted, and once incentives change, outcomes follow whether anyone acknowledges them or not. The assumption that finally begins to fail is the idea that paper liquidity can always substitute for physical reality. For decades, silver markets functioned on the understanding that most participants wanted exposure, not delivery. That assumption allowed hundreds of paper claims to exist for every ounce of registered metal. It worked because it was rarely tested. February 5th wasn't a collapse of that structure, but it was a stress test that revealed how dependent it is on cooperation rather than capacity. What matters now is not the absolute level of price, but the behavior of participants after the shock. And that behavior is already changing in ways that don't show up immediately on a chart. Delivery is being treated less like an exception and more like an option worth exercising. Inventory drawdowns are being watched more closely than price action. Regional premiums are being taken seriously instead of dismissed as noise. These are subtle shifts, but they compound over time. There's a misconception that scarcity announces itself loudly. In reality, scarcity usually arrives disguised as inconvenience. Longer wait times, higher premiums, tighter terms, less flexibility. Each change on its own feels manageable. Together, they signal a system that is no longer elastic. When elasticity disappears, volatility becomes more dangerous because it no longer dissipates evenly. It concentrates. This is where psychological fatigue enters the picture. Violent sell-offs exhaust attention. People disengage. They assume the worst is over because they're tired of watching. That disengagement reduces speculative demand, which keeps prices suppressed longer than fundamentals would suggest. But suppression under these conditions doesn't resolve imbalance. It deepens it. The longer price stays disconnected from physical signals, the more dramatic the eventual reconciliation becomes. For industrial users, this environment forces a reassessment. Silver isn't optional for modern infrastructure. It's embedded in energy systems, electronics, data processing, and manufacturing. When markets behave erratically, those users don't gamble on spot availability. They secure supply, they lock in contracts, they accept higher costs in exchange for certainty. Each of those decisions quietly removes metal from the open market. This is why falling prices don't necessarily loosen supply in stressed environments. They can do the opposite. They encourage accumulation by those who need the metal, regardless of price, while discouraging speculative selling by those who don't. Over time, this bifurcates the market further. Paper activity becomes increasingly detached from physical flows. Price becomes less informative. There's also a broader macro layer that can't be ignored. Silver exists within a monetary system under strain. Debt levels are high, fiscal flexibility is limited, policy responses increasingly rely on distortion rather than correction. In that context, hard assets inherit a different function. They become references for trust. When trust in institutions weakens incrementally, demand for tangible assets grows not explosively, but persistently. The irony is that repression often appears to work until it suddenly doesn't. Synthetic supply can suppress price for long periods, especially when participants remain confident in settlement. But confidence is not a fixed variable. It erodes with each episode of divergence, each delivery delay, each rule change. Eventually, the system reaches a point where additional paper no longer calms the market. It agitates it. At that stage, behavior shifts again. Participants stop asking what silver is worth and start asking what it costs to obtain. That's a subtle but profound change. Value is abstract. Cost is immediate. When cost becomes the dominant concern, repricing no longer requires consensus. It happens transaction by transaction, contract by contract, outside the spotlight of future screens. The risk, then, is not a single dramatic failure, but a gradual loss of relevance of the paper price itself. When enough physical transactions occur at premiums, the screen price becomes a reference point rather than a clearing mechanism. Markets can function that way for a while, but not indefinitely. Eventually, one side has to yield. Either physical supply increases meaningfully, or paper claims lose credibility. There isn't a third option. This is why the question of timing remains so uncomfortable. Structural pressure doesn't operate on a schedule. It builds until a catalyst forces recognition. That catalyst doesn't have to be dramatic. It can be as mundane as another delivery cycle, another inventory report, another regional premium that refuses to compress. Each event adds weight. The people most exposed in this environment aren't those holding metal. They're those assuming liquidity will always be available at posted prices, that exits will remain orderly, and that rules will remain static. Those assumptions are reasonable in stable systems. They become liabilities in transitioning ones. February 5th didn't punish those assumptions decisively, but it weakened them enough to matter. So the final frame to hold is not optimism or pessimism, but awareness. Awareness that the system is adapting, not resolving. Awareness that volatility is a symptom, not the disease. Awareness that price alone is no longer sufficient to understand what's happening beneath the surface. And that leads to the question that lingers after everything else fades. If a move violent enough to erase decades of chart memory and hours didn't restore balance, didn't loosen supply, and didn't rebuild trust, then what exactly is the market waiting for? And when it arrives, will it look like a shock, or will it feel like something that, in hindsight, was quietly inevitable all along?